Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar, Calgary Stampede edition. Welcome to the live taping. This is not a day 5 hungover crowd. You guys brought the energy and I'm so excited. Our very first taping of In the Money live with an audience, and we are so grateful to have this conversation with Adam Waterous of the Waterous Energy Fund. Give it up for Adam. None of this would be possible without ATB Financial, which is hosting us today, and a special shout out to Lori, Crystal, Kate, and John, who are bending over backwards to put on this event. So if they'll do it for me, imagine what they'll do for you as a customer. Am I right? And to our subscribers who came in person, thank you so much for taking time out of your day, out of your pancake breakfast to be here, because we are going to have a great conversation with Adam Waterous, who, as many know, is head of Waterous Energy Fund, the executive chairman of Strathcona. He's got a little bid out there for MEG Energy, and we're going to talk about that. What do you say? Let's get into it.
I'm ready.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. If you're looking to explore the world of options trading, having the right tools is essential. The BMO InvestorLine self-directed platform offers a suite of features designed to help you analyze opportunities and execute your strategies effectively. Discover advanced charting, real-time quotes, strategy builders, and risk management tools, all within the powerful platform. Take control of your options trade and explore their potential with BMO InvestorLine. Start investing today at bmo.com/investorline.
So, Adam, I read an article about you in 2017. And in 2017, you had just left Scotia. Scotia bought Waterous & Co. And at Scotia, you were the guy when it came to energy investment banking and indeed global investment banking. And then you left. And you said in 2017, I'm going to go back. I'm going to focus on oil and gas. I'm going to buy assets. Everyone's ignoring it. And I'm going to make one of the biggest producers in the country. And then you did. You did exactly what you said. It wasn't a secret. You did exactly what you said that you were going to do. So what I want this show to be about is the next 7-10 years, because you were so good about telegraphing what that was going to look like. Because we're at a moment of change. What is the future of Canada's energy sector? You know, we're going to talk about it from consolidation. We're going to talk about it from regulatory, from politics, from the environment. But I think, Adam, to understand the future, we need to understand you and your bent and your approach to investing in the energy sector. How would you summarize it?
Thanks, Amber. That's very generous of you. So when we started in 2017, we were a startup, and every startup has an advantage versus the incumbent in that you're not bound by the historic orthodoxy. This is in any sector, and investing is the same, and investing in the oil and gas sector is the same. And what we did, which was unconventional back in 2017, is that we thought we'd have a different investing strategy, we'd have a different operating strategy, we'd have a different management strategy. And it was not meant to, sometimes people kind of say, well, you were contrarian. We actually didn't think we were contrarian. We thought that a better description is heterodox, which is just looking at the environment and trying to craft strategies to adapt to it. And so our investing strategy, we looked at historically what had been the sort of tactics or thought process that investors had used across North America for many decades, like 50 years, long time, had been a growth equity. And essentially how investors approach the sector is they would try to identify very strong technical people, really strong geologists, engineers, geophysicists, and they would back them with money, and those teams would go out and try and find tier 2, tier 3 assets. Tier 2, tier 3, I mean, they weren't working very well, and they could buy them cheaply that way. But because they were really smart, they could come up with some kind of new technical hypothesis. It could be like a bypass pay or some kind of completion technique. And if it worked, they would build a 20, 30, 40, 50,000 barrel a day business and sell it. Now, that very simple description would probably cover about 90% of the startups in the oil and gas business over the last 50 years across North America.
90%.
90%. It was the overwhelmingly dominant investing strategy. Anyway, we didn't like that strategy. We think it was a different strategy. We used a value investing strategy. And value investing sounds kind of fancy, but what it really is a real focus on protecting principal, trying to avoid loss. Meaning, growth equity is kind of a swing for the fence, looking for home runs. But when you do that, you strike out a lot. And so, how most investors deal with that, by the way, is through just portfolio diversification. Is they say, geez, yeah, I'm going to back a whole bunch of teams. And a lot of guys, are going to lose a lot of money, but I'm looking hopefully for a couple of 5 baggers to make the math work. We didn't like that. We said, we don't want to lose any money. And so what we did is we said, why don't we focus on, to avoid losing money, let's deal with the risks in the business upfront and be direct about it. And in the oil and gas business, there are 4 big risks. The first risk is technical risk, and that is, turning around those tier 2, tier 3 assets usually fails. So we didn't want to do that. We wanted to buy things that were on stream today. So we didn't take that technical risk or minimize as much as possible. The second big risk in the business is price risk. Prices go up and down all the time. It's not if prices are going to fall, it's when they're going to fall. And how most people in the industry dealt with it is through hedging. We go into the forward market and try and lock in prices for a couple of years. And we do lots of hedging. But what our experience is, the real way to deal with price risk is to buy top quality assets. And the neat thing about the industry is that identifying top quality is very simple. There's only 2 metrics you have to think about. One is, what is your sustainable break-even price? And that is, at what price do you cover all your costs, including the capital to hold production flat? A lot of people forget what that second piece on. The lower that price is, less price risk you take. The second metric for quality, which tends to be important for price risk, is reserve life index. And that is, you take what your existing production is, divide that into your total reserves, and the longer that number is, the less price risk you take. Now, why is that? Well, it's for a couple of reasons. Number one is when prices fall and you're continuing to produce, if you have a lot of reserves, you're not running out of reserves in a low price environment. The second thing that a long reserve life index gives you is a low decline rate. So if you have, say, a 20% decline rate versus a 40% decline rate, and prices fall and you have to cut capital, you don't work yourself into a big hole. So that's the second thing we're really focused on. Third big risk is leverage. This is a real asset business. The industry is prone to over lever. And so as we built our business, we generally kept our leverage low, 1 to 2 times debt to EBITDA, debt to cash flow. And then the last risk is exit risk. And because a lot of people, get into these businesses, and then often they get very hard to sell. And so we wanted to be big enough so that we could just take the business public and have liquidity that way. So that's how we started off from an investing strategy by perspective.
Which is great, and that's how you've built a business that started at 0, and now Strathcona, many people might not realize, is a top 5 or top 6 producer.
Fifth largest oil company in Canada.
5th largest oil company in Canada. So up there with the big boys or girls, but Canadian Natural Resources, Suncor. So all those names that you would know, Strathcona's just not in the index, maybe yet. So maybe not as much of a household name. But at the end of the day, you're still, whether you make money or not, at any oil price or a low oil price, investors, especially in the public markets, they either like oil when oil prices are higher, or they don't like it when oil prices are lower. So how do you think about that? Because you it seems like you're so operationally focused, but you can't divorce yourself of timing and what the oil price is doing.
Yeah, you're right. The price of oil is beyond our control. And so the only thing you can really do is manage the business to be a low-cost producer. And that's why I'm going back to high-quality properties. That's what really insulates you from it. So part of the trick in this business is that, when I talk about, we're focusing on all these low risks. If you take all this risk out, well, how are you going to make any money? So what's the value added component? Well, one of our operating strategy, we had a very different operating strategy in that the dominant operating strategy across North America for the last couple of decades is to have be a single play company. And so what you try and do is you say, okay, I'm going to build my business in the northeast quadrant of the Delaware Basin and the Permian in Texas. Just super concentrated, real micro. And the reason people did that is that that was the easiest business to sell, because then people would be very easy to integrate on it. And that was the dominant strategy. And what we realized is that the challenge with that is it's very difficult to get economies of scale and operating synergies. And so what we said is, well, what we're going to do? We're going to consolidate these single play companies and buy similar businesses, but have better purchasing power and better cross learnings between assets by buying up these businesses.
You make it sound so easy, and you tell everybody that that's what you're doing. And I know it's not easy, but I wonder why more people aren't doing it. And as you're raising your funds, and I know you've had success in raising your funds, but can you think of examples, if it's a specific example or generalization, of the naysayers? I'm sure you've had your fair share, maybe especially when you started in 2017. What do they say to you?
Well, generally speaking, if we encounter a naysayer, I generally ask, do you own any oil and gas businesses I can buy? Okay, because we love the Bears. Okay, that's what I'm always thinking about. It is kind of interesting. So we started at 5,000 barrels a day. We just sold some assets. Just before we did, we were producing just under 200,000 barrels a day. We invested over time 1.9 billion. The Canadian dollars today is worth a little over 6 billion. Now, in that time, that was from 2017 to now. Generally speaking, the industry has faced a combination of stiff headwinds and a high degree of, I describe, investor skepticism on it. I mean, put another way is, if you describe business, we have some.
Swear. It feels like you want to swear.
Yeah. I mean, I would say it'd be another way of putting it. Strathcona reached $4 billion in revenue faster than any company in Canadian history in any sector. Now, if you're from Bay Street, and if you ask people on Bay Street, hey, what industry reached $4 billion in revenue faster than any company in Canadian history?
It's a tech.
They say tech. I don't think say that. So I think that people get, it's very easy to get into a group think on it and think, well, there just really isn't this opportunity. And so, in some respects, that group think you can take advantage of. Now, what's kind of funny about it is, I've been super public about this. I've been from day one. I said, I think this is where the opportunity is. This is what we're going to do. And as we've gone along, to your point, I always kind of expected more competition. Because I always said, well, geez, everyone's going to see it. Man, this is working. People maybe really get entrenched in their point of view.
I think of like maybe Canadian Natural Resources, like they love the low cost. Everybody says $40 is theirs, and they love to be counter-cyclical in their acquisitions. Do you see parallels, and do you see yourself, being that size and scale? Is that where you're taking the business?
Well, first of all, Canadian Natural Resources is a fabulous company and is great to be admired. And we have a lot of respect for the business, as we have with many other the large producers on it. We do think, a part of our sort of core operating assumption is that what has happened in the business is that for a very long period of time, approximately 50 years. 50 years is a long time. It's 2 generations. Is that this was a super fragmented business, very entrepreneurial, lots of startups, very dynamic, which is kind of exciting on it. When I say 50 years, basically mid 60s to 2015. So it's a long time on it. But our general thesis, and I kind of got into the business, is we thought, we think that this is going to become a very concentrated, consolidated business. And the reason being is, it goes back to what I was saying about core area consolidation, is that these single asset play businesses do not optimize the economics of the business. You need to be very large in scale so you can share learnings across assets. But another way is, sometimes, if you've got a single play company, and we're buying it, some people think that people who are running them are dumb and lazy. They have a structural impediment in optimizing them because of their scale and because they are not able to get learnings across assets.
Do you have a view on oil prices? Like, I'm sure you have one, but are you factoring that into any of the investments you make?
Sure. In the commodity business, you can't not have a view. And
you love a price target.
You can
throw
so
one
you
out.
can't not have a view. But our dominant thought is, what you want to be is the low-cost producer, because there's going to be tons of volatility, tons and tons and tons of volatility on it. So again, it's not if prices are going down; it's when are they going to go down. And so if you're going to be the lowest cost producer, that's what really protects you. Now, having said that, when we started the business, my colleagues and I started the business first with my oldest son, Connor, who was at a big investment firm in the United States, KKR, and he was investing in oil and gas, and across the United States. And I think got joined by another couple of colleagues of Connor from KKR, and we continued to expand the team. My wife and I have 2 other sons, and they've also joined me. They were also doing oil and gas finance before joining us. And we've got a very good insight into, we think, into the overall opportunities in the United States. And we made a determination pretty quickly that there are more attractive investing opportunities in Canada versus the United States.
Why?
So, generally speaking, is that the United States is running out of oil reserves, and they're running out of oil reserves quite quickly. And it goes back to what I was saying about long reserve life index. And so, to give you a sense on that, Strathcona's reserve life index is as a proved plus probable basis is 50 years. Companies and large companies in the United States, very high quality businesses, might have 10 years worth of drilling locations. Like super, how we feel that is super short.
Yeah.
And so, and we've had a long-term point of view. And so we think that the opportunity to build big scale business is much more attractive in Canada than in the United States.
Okay, I think I've gone as legally along as I can without bringing MEG Energy into the conversation. And that actually segues nicely into MEG Energy. So you make this bid for MEG. You know that the stock is trading above your offer price, and I'll poke you on that. But first, I want to know, MEG has just been, in my career, MEG's always been a takeout candidate, right? It's just been floating along, waiting for some other player to come and scoop it up. And I want to know why now.
Well, we're doing it for 3 reasons. The first reason is Strathcona and MEG are extremely similar. I like to say they're doppelgangers. They are twins. Strathcona is a bit bigger. We're producing 120,000 barrels a day. MEG's producing about 100,000 barrels a day. We both have a 50-year reserve life index. We make a little higher margin than they do, but it's very similar on it. Why that ends up being important is because of the very similar nature, we can continue to extract economies of scale, operating synergies. And what I mean to give you a sense on that. So this MEG, should we be successful, this will be the 6th SAGD business, steam-assisted gravity drainage, thermal oil business that we've bought. And what we have found is each time we buy a SAGD business, our existing SAGD assets, we get operational improvements from them. We get economies of scale, operating synergy. So to give you a sense, if we, with MEG, Strathcona will be drilling about a quarter of all of the SAGD wells in Canada. And SAGD is a very big business. It produces about 2 million barrels a day in total on it. So we'll have very powerful operating synergies. So that's the first reason, is it was very similar assets, assuming operating synergies. Second reason is we have these very rare financial dynamics in that typically how M&A works is that a bigger company buys a smaller company. And typically, the bigger company trades at a better multiple than the smaller company. So the bigger company trades at, say, like 7 times, and the smaller company trades at 5 times. And so Strathcona is a bit bigger than MEG, so usually we're trading at a higher multiple than the target. And the bargain is this, is that the smaller company gets a premium. And so say the smaller guy trades at 5 times, say it's a 10% premium, so they're exiting at, say, 5.5 times. The bigger guy, who trades at a better multiple, say 7 times, they get accretion per share. That's kind of the bargain.
Yeah.
That is the vast majority of M&A. Not in this case. It's a very unusual case in that the bigger company, Strathcona, actually trades at a discount to the small company, MEG. And the reason being is that Strathcona has a very small public float. Our private equity fund, Waterous Energy Fund, we started out, we took the business public in a reverse takeover about 1.5 years ago. We own 91% of the business. We've distributed some of our shares to our investors. We now own about 80% of the shares. But we don't trade much in the public market. We trade a couple $1 million a day. That's very little on. In contrast, MEG, they trade about $100 million a day in the marketplace. So they very fairly, justly, trade at a better premium to us. What that creates is this very strange dynamic, is that what we've done is we offered MEG, firstly, a premium, it's about 9% on the day, so to speak. But the second thing is, instead of them getting diluted, they actually get accretion because they trade better than us. So to give you a sense on that, and whether you look at cash flow per share or NAV, sort of between 10 and 25%. So averages call around 16%. So they get 9% up front. Then they actually get per share accretion, say 16%. So now they get 25%. But then the third bump they get is why we're doing the deal. It's why Strathcona is doing the deal. We're getting a little bit of accretion, but that Strathcona, which is the shares, because it's 82% shares, 18% cash, is that we think we're going to trade better in the market. Now, why do we think we're going to trade better in the market? Well, there's 3 reasons. The first reason is that pro forma, Strathcona will be upgraded to investment grade, so lower our cost of funding. The second reason is we'll have more liquidity, so we'll be able to be included in some indices. So these are 2 very immediate things or near immediate things happens. The third thing that's going to happen is that Strathcona is going to occupy a very unique investing space in North America, in that we'll be producing day one about 220,000 barrels a day of oil. Our plan is to grow, just adding the 2 business plans together, to about 325,000 barrels a day. We'll have about 1.8 billion net proved reserve, which is a U.S. convention. So we'll have the net same oil reserves as, say, an Occidental or a Diamondback. These are very large companies that have a multiple of our production, but they'll have a much shorter reserve life index.
So that answers the question if people want to know why do I want Strathcona to own MEG assets and participate in that. But maybe people are simple, like me, for example, and I just say, well, the stock is trading higher than what you're offering, so why would I do that? And I want to know, are you interested in sweetening the bid?
So, I don't know if you ever experienced this, but if you ever go up and you say, you knock on a door, of a house, and the owner comes to the door and says, I really want to buy your house, and here's an offer. In my experience, I don't know, it might be unusual. It's not surprising when that owner of that house says, hey, that might be interesting, but do you have any more money there? So that's not an unusual, reaction. Now, how the dynamic works in a transaction like this. So what we did is we've made what's known as a direct to shareholders offer. And the reason we made a direct to shareholder offer is we approached the board of directors of MEG in late April and said, hey, here's an offer. We think this is a very compelling transaction. And MEG's board never called us, never engaged with us, they just sent a short note, not interested. And said, well, geez, I understand what your point of view is, but geez, what do you think maybe what the shareholders might think? And so that's why we then publicly announced our intention to make an offer, and now we've made an offer, and the offer is out for shareholder consideration, and there'll be a vote on September 15th, and the shareholders will make a determination as to what they want to do. Now, that's kind of the process. Now, here's maybe sort of some of the dynamics. The day we made the offer, the stock jumped about 19%. And so what that indicates is that the shareholders are looking for a change. So they say, gee, status quo, they've already kind of voted with their feet on that. And then they obviously then think, one of the things we said is when we made the offer, we said, we actually went and before we made the offer, bought 9.9% of the company. We said, we think we've got a really good offer here, but maybe somebody else has got a better offer. Why don't you put the company up for sale and we'll see? Because then you don't have to guess, like, maybe is this a good one or a bad one? Well, let's just see which is the best one. And very fortunately, MEG's board did agree with us and put the company up for sale. And have said publicly that they're soliciting interest, and we'll see if anyone comes forward with something that might be more attractive.
It was such a long way to avoid my question. But I feel like we did get some insights there. So let's see, how are we going to do this? If someone comes in, and that's what the thinking is, and it's higher, you have a decision to make. Are you going to tender or top?
So here's what I think we'll.
Don't tell me another house story.
Yeah. So here's what I say. It is very natural. The share price performance is very typical. Okay, is that an offer now has been made, and it'd be very expected that the shares would trade through that offer. Now, it would trade through that offer for two reasons. The first reason is that there might be someone else who comes along and makes a better offer. And so the investors will speculate, maybe someone else comes along and tops the offer, and therefore I can try and maybe play that little bit of arbitrage. The second reason is investors might say, no one else might come forward, but maybe MEG can get the Strathcona to increase their bid. Mm-hmm. That's kind of the speculation that happens. Now, on the first dynamic, could there be what is often called an interloper come along? We're going to see. Company's available. It's for sale now. It's in play, so to speak, and we'll see.
Do you have metrics that you use, a red line that you won't cross in terms of overpaying? Maybe then we can all do the math ourselves.
Well, here would be. So it's kind of funny. What tends to happen in these dynamics is there tends to be a lot of psychology starts getting used to. You say like, is XYZ's CEO, is he an empire builder? Is he looking to put a stamp on it? You hear all this, drivel. That doesn't really mean anything. If you want to try and really play the game, I would encourage and this is for this transaction or any transaction in the M&A business, is I think about two things. The first thing I would think about is what company gets the most value from the acquisition. And in this particular case, there are several sources of value. The first source of value is operating synergies and economies of scale. In that case, there's actually several companies. Strathcona's one, but I would argue that all the big SAGD companies will capture operating synergies, economies of scale from that. So we'll capture that portion. There's then three more pieces of value that are unique to Strathcona. Number one is Strathcona gets upgraded to investment grade. Any other interloper is already investment grade. Number two, Strathcona will be included in indices because we have more liquidity. Any other interloper already is included in the indices, so they don't get that. And number three, Strathcona being in this unique position of being the largest pure play oil company by a very wide margin, by a factor of 5 or 6 in North America as a pure play oil company that does not own refineries or mines. We think that's going to be a very unique investing proposition that only Strathcona gets. So we think, again, don't ask your barber if you need a haircut, okay? We think we're uniquely positioned. But that's the first way to think about it. Now, here's the second way to think about it.
Tell me.
Every M&A decision that companies have, they have a buy versus build, okay? And they say, I might buy something, but maybe I can just organically grow it. Now, all of the companies in this business, who could be interlopers, have, frankly, an embarrassment of riches of resource. They have a huge number of organic growth opportunities. Their opportunity to build something is very high. And so what they'll say is, well, geez, what can I build this? What can I build something that looks like MEG, or versus what it's going to cost to buy? And a lot of those companies, just like Strathcona, we think we can organically grow these things at some kind of $25,000, $35,000 a flowing barrel a day. Our math is very simple. We're paying about $6.7 billion for 100,000 barrels a day, so we're paying something like $67,000, maybe $68,000 a flowing barrel a day for that. So it's about twice what an organic growth opportunity would be for some of the big guys. Now, that doesn't mean the big guys won't do it, but that ends up being a very big factor in just how they think about it.
Has MEG engaged with you? You mentioned when you first privately did the deal, they just said no. Yeah. But now, are you talking to them?
We're trying, but they today have declined to engage with us. So we've never had a conversation with the board. They've never reached out to us. We've reached out to their financial advisor to say we'd love to get involved in the process, but they have declined.
Now, so you're not even included in the process?
Not included in the process. Not included in the process. So I would just say, I'd make a couple of observations about that. So far, you mentioned up front that, so MEG was founded in 1999. In the year 2000, it became a takeover candidate. So MEG's been a takeover candidate for 25 years. That's a long time. I'm not sure that's Canadian record, but it's getting into that neighborhood. Okay, in that time, they've had two offers. First offer they had was from, back in 2018, was from Husky Energy, which they rejected. And that ended up being a very poor decision for the MEG shareholders. The second offer is from ours. So it's not like, guys are making offers all the time. 25 years, they got two offers on it. Now, in our case, since in the last 6 years, our firm, Strathcona, has bought every SAGD business sold in Western Canada that didn't have a ROFR, didn't have a right of first refusal on it, could be bought on it. So we're the only guys so far who said, geez, we really want to buy the business. We've bought a lot of these businesses, and we think we can, this is one more business that would make sense for us to buy.
If this doesn't go your way for whatever reason, and it seems like you're hungry for another acquisition, others have mentioned names like Athabasca as a potential. Like how long is your list of other potential opportunities?
So, I'll give you a longer answer than a short answer. Let me start with the short answer. The short answer is MEG is a very unique situation in that it makes us investment grade. It gives us liquidity that provides us to be included in indices. Other targets, smaller ones, such as say Athabasca, very fine business, doesn't do it for us. Doesn't mean it's not a good business, doesn't do it for us. So that's, MEG's very unique in terms of what it does for us, and it accelerates us. Now, we always describe internally, buying MEG as our Plan A plus transaction. Plan A is just before we announced our offer for MEG, we sold our Montney business, and maybe let's talk about that for a second. So we liked our Montney business. We think it's a very fine business. It was a natural gas business, natural gas liquids, and we were proud of it because we'd grown it from 5,000 BOEs a day to 75,000 BOEs a day. We thought it was very high quality. Its reserve life index was 24 years. It was quite profitable. A metric that listeners might find useful is PIR, which is your PV10, your discounted value in terms of how much capital you put in. If you put in $1, in that case you get $2 out. So it was a very profitable business. But we sold it, and we sold it because it was in 3 different areas of the Montney, and we thought that we wouldn't be able to get critical mass in each one. So we sold it to the three biggest producers, natural gas producers in Canada. And we think they're going to do very well with it because they're going to be able to get operating synergies, economies of scale. But we sold it for, this is all publicly announced, we sold it for 1.2 times PV10, about an 8% free cash flow yield. Now, the case of Strathcona trades at about 0.6 times PV10 at about a 17% free cash flow yield. So we sold our natural gas business for roughly double what we trade at. So that's pretty good. But that's actually not the good part. The good part is that what we're left with is we have a 50-year reserve life, and our profitability metric for what we've got left is generally around 4. So we sold something for twice what we sold it at, or we trade at, and the asset quality by reserve life index profitability was half. So it was a 4-bagger. So suddenly now it's what we're left with. Now we've got 120,000 barrels a day. Our business plan is to grow the business by 2031 to 195,000 barrels a day. We've got no debt. We've got $200 million in cash on the balance sheet. So we think, gee, that's a pretty good situation to be in. So what we'll probably do is, if we don't buy MEG, we'll probably, issue a dividend of maybe about $10 a share. At that point, we'll be about 1 times debt to EBITDA, still very lightly levered.
Like a special dividend.
A special dividend. And continue on. So we think that's a really good plan A. And we just think MEG's plan A plus.
Okay, you can exhale. Those are all my MEG questions.
For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned.
Now we can talk about something easy like politics. Andrew Willis at the Globe and Mail wrote that you had a meeting with Mark Carney because you also are on the forefront of initiatives about, Canada getting its act together, and specifically around on energy, but just kind of in general when it comes to our productivity. And he made the connection, you met with Carney, and then, here you are making a bid for MEG. And so that must mean you have some sort of confidence. Like if you were nervous about Carney and what he meant for the energy sector, you wouldn't have bid for MEG. I guess this is still kind of a MEG question, but I guess the question is that the right inference?
So, yeah, here's what I'd say. I would talk about politics. I'm a big fan. Everyone's got opinions. Okay, I'm not more interested in what are you doing. Okay, So And I'll answer your question very directly, but I think it's very helpful to have context, is that we think that what society is facing is a climate change challenge, but we have an energy poverty emergency. Now, from a climate change challenge, to talk about that first is Strathcona is the first and still only oil sands company that has reached a fiscal arrangement with the federal government to invest in carbon capture and storage to decarbonize its oil sands business. It's a $2 billion transaction. We announced it last summer in partnership with the Canada Growth Fund. It's something we're very proud of, and I'm excited about the opportunity. And this might reduce our carbon intensity by something like 80%. So we'll see what it actually is in practice, because no one's ever done something of this scale before. So we're really putting our money where our mouth is on the decarbonization front. At the same time, we think we've got an energy poverty emergency. And I quickly would say is, emergency is a term, like a lot of terms, kind of like world class. It gets thrown around a lot. And what I would say is an emergency is, from a definition perspective, is there is a near-term chance of loss of life. Now, right now, there are about 8.3 million people dying every year from energy poverty. About 60% of that is from inaccess to proper heating and cooling. And of that, by the way, 90% is from inaccess to proper heating on it. The balance is by inhaling indoor air pollution as a result of burning wood and dung indoors for cooking on it. That's not speculation. That's not like, oh, we think in 2050 or we think in 2070. These are 8.3 million people dying every year. Now, I think that from Canadians' perspective, if someone said to us, there are 8.3 million people dying every year, and if Canada had a vaccine that could help reduce those deaths, I think a lot of Canadians would feel that Canada has a moral obligation to deliver that vaccine. I think the same thing about producing oil and gas, and to help reduce that energy poverty emergency. And that's why, for several years now, I've publicly called for Canada to double oil and gas production. And I think it's very exciting that we also have here in Alberta, Premier Smith is also calling for the doubling of oil and gas production. So that's the macro, okay? And that's where I think we have from a moral obligation as Canadians we need to do.
Do you think Carney sees it that way?
Well, I certainly have told him. That's certainly my perspective. I think that, and so that's a...
The reason I ask is because I know you're an environmentalist, and we know Carney's an environmentalist. And so it's kind of at odds that you're an environmentalist in an oil and gas business. So it sounds like you found a way to reconcile it. And is that a playbook for Carney to reconcile it?
So I think that what's very exciting is that when you think about politics, and if I was a politician, I'd do the same thing, is that politicians really follow public opinion. And what has been quite remarkable is over the last 6+ months, Canadian popular support for the development of energy infrastructure has really changed. It's generally gone from it, like in 2017, I think it was in the high 40%, I think 47% of Canadians wanted development of more energy infrastructure, LNG, pipelines. Today, I think in every province, I think, except Quebec, it's over 70%. And even in Quebec, I think it's 60%. So it's been the popular support for the development of energy infrastructure in Canada has almost doubled. So quite a so I think when I always think about, well, what are the politicians going to do? I always think, well, what are Canadians thinking? Now that's a very important data point when people think about making investments. Is what's the population going to do? Now, having said all that, I think it's really good that one of the things that Mark Carney did when he was running for the Liberal leadership is he said that he was in favor for the development of energy infrastructure, oil, LNG pipelines. And so what a group of energy leaders did is to try and help guide him and other federal leaders as to what he might be able to do.
Was he receptive?
We came up with this Build Canada Now letter, and it was very specific on if you want to build energy infrastructure and you want the private sector to do that, these are the changes you got to make. Well, you got to scrap C69, the environmental impact assessment. You have to scrap the hard cap emissions. You've got to scrap C48, the tanker ban. You've got to scrap the industrial carbon tax. You've got to provide indigenous loan guarantees, and you've got to focus on a 6-month approval process, down from 5 years. Now, that's if you want private sector money. And we were very clear, now, that's if you just want private sector to do this. The alternative is you could use public funds, and have state-owned enterprises. This is state-owned enterprises is very similar. So what the Chinese Communist Party does is they use Sinopec, CNOOC as instruments of Chinese state policy for development of energy sector. That's a bona fide method as well. That's what Canada did with the development of the Trans Mountain Pipeline. They used a state-owned enterprise to be able to do it. And some people like state-owned enterprises do it, and some people think it's a bonfire for a public purse. It's going to depend on what the government's going to want to do. But what we've been very clear to the government is if you want private sector capital, these are the regulatory requirements that are going to have to be changed. And we've met and I think had very frank and open discussions with Mark Carney before he's Prime Minister, with Mark Carney now that he is Prime Minister, and we're all going to see in terms of what decisions he makes.
There is, in some ways your success has been allowed or facilitated by the fact that global pension funds and global companies have turned their back on Canada's energy sector. And it's created opportunities for you to go into these ignored, low valuation sectors. And I wonder, which is, I guess, great for you, not necessarily great for the country. What do you think needs to change to make Canada re-rate on a global stage?
So I think when you think about Canada, because it's really, complicated, like, global stage, like, I hear those guys in Norway are really anti. It's like, that's background noise. All you have to think about is being competitive with the United States. Roughly 90% of the capital to develop the Canadian oil and gas industry has come from and will come from the United States. So all we have to do is be competitive with the United States. Don't get hung up on that. And essentially, that Build Canada Now letter that we sent out, the CEOs, the big energy companies sent out, could have been titled "How to Be Competitive with the United States" on it. It was not really more complicated than that on it, because investors have a choice.
And you've made a point, I've heard you say that Mark Carney can actually use pipelines as a bargaining chip with the United States as long as he favors the private sector solution. Can you elaborate?
Sure. Sometimes there's a lot of narrative as well as that, geez, I don't know how we're ever going to deal with Donald Trump. Like, he's a real mystery. He changes a day, every day he changes his mind. It's false. It's totally false. Donald Trump has been consistent for 9 years. He ran when he was running for the Republican nomination in 2015 on a core idea, one of his core ideas. He wants more Canadian oil. That's what he wants. It's not some mystery. So I can't figure it out. No, he's very clear. He's been very specific. He wants Keystone XL. So, and I quickly would say, the energy industry has been saying for a long time, more than 8 years, that actually we got all the oil we're going to the United States. We'd really like to have some diversification. That's why the energy industry 8 years ago said, hey, we want Energy East. Hey, we want Northern Gateway. And now, essentially what happened is that the government of the day made the determination that, well, geez, there were 3 pipeline proposals, the third one being Trans Mountain. So tell you what, we'll give you one and we'll block two others. And it was kind of a political decision. But the fact that those 2 pipelines did not get built that's how we lost the trade war. Like, and by the way, made no mistake, we have lost the trade war. We are totally on the back. Here would be another way, but there had been no trade war with Canada if we'd had those two other pipelines. And the reason being is the United States is short oil. The United States produces 13 million barrels a day. They consume 20. They're short 7. We provide them 4. And unfortunately, then that 13 million is going down. So they're going to become more dependent on us. And so that's the real trump card that we've got.
And I feel like I covered that whole situation as a reporter, and I don't even know if I got the CEOs on to talk about it. Maybe they wrote a little bit of an angry letter. But where they talk about it in whispers and they talk about it off the record, and you're so vocal as a Canadian executive about what needs to happen in this country, what you don't like. Why don't your peers do more of this?
Well, a couple observations. The first is taking away from the Canadian is the energy sector. I think historically, Canadian CEOs in all sectors have been comparatively more quiet, more reluctant to go publicly on the record. They've been more inclined to have industry associations speak for them. Now, been in the business news business. I think you'd find it quite different is when you go on the U.S. business news shows. You've got CEOs, American CEOs, going all the time saying, "This is what I think. This is a bad policy. This is a good policy."
I do know that because
Canadians have been very much more reluctant, or you might describe it as if they do say something, it's kind of milquetoast. Now that's historic. Now, having said that, what's just happened is, I think it's really changing. Now, why is that changing? Well, we've just gone through a period in Canada, the last 10 years, where we had the worst economic performance in Canadian history. Now, that's a pretty good soundbite. Worst Canadian. In fact, you have to look at it is when you're looking at developed country economic performance over the last 100 years, you have to look at 946 to 54, Juan Perón, Argentina. So what we're looking at is the worst economic performance in the country for the last 10 years, Canadian history, maybe the second in the developed world in the last 100 years. That's bringing people out and being forward. And so that's, I think, in part what brought the not only the energy executives to sign their name to this letter, but it's also led to multiple other CEOs in other sectors put their name on letters saying, there's CEOs for Free Enterprise put out a letter after the oil executives guys said, I think they kind of said, hey man, these guys didn't get shot when they did that. Maybe I'll take that chance too.
Before and we have to wrap up here, but just maybe on a personal note and professional, because you've been working in this space and thinking about Canada deeply, how do you think about what you want your legacy to be?
I'm not a big fan of legacy. I think you always got to be thinking about moving forward. I think that Canada generally has a very bright future. I think to bring it back maybe to ATB and Alberta, Alberta has an extremely bright future. I would really, and I say that not just to root for the home team. We are sitting right beside an economic juggernaut in the United States that has a massive Achilles heel, and that is their short energy. We're long energy. I love the dynamic over the next 20, 30, 40, 50 years that Canada has in terms of being able to support that economic juggernaut.
Adam, thank you so much for joining us. Please, a warm round of applause for Adam Waterous.
Thanks, Amber. Really.
And thank you to everybody who tuned in. On our next episode, we've got Gordon Reed on the show. He's talking about U.S. stocks. So you can email us your questions at inthemoneypod.com, or find us anywhere on social media at inthemoneypod. And we'll see you on the next episode.